Good afternoon. So I am not an expert on direct indexing. I'm many things, but I'm not a CFP professional. I'm not a direct indexing expert, but I'm very fortunate to be joined on stage with three men who are. So maybe I'll start with the question for the uneducated like myself. What is direct indexing, and how has it changed in the last couple of years?
Thanks, Ian. Really appreciate you asking that question, and thanks for everyone for attending this session. So direct indexing is not new. The term might be new, but it's a strategy that's been around for a while. So some of you are probably very familiar with this, but essentially it's an SMA, where a manager like Vanguard perhaps is buying a collection of stocks for that individual client, tracking an index, but not necessarily buying every single stock like we might with an ETF or a mutual fund. We're buying a handful so that we can have some tax loss harvesting pairs. Because in direct indexing, you're taking advantage of the dispersion of underlying stocks. Some of them are going to go up, some of them are going to go down every single year. You tax loss harvest, much like you do with ETFs and mutual funds today, but you've supercharged it because you've got more tax lots available. You also get the advantage of having some customization. You can pick specific things that you want to emphasize or avoid, ESG factors, individual securities, what have you. So there's two main benefits. And there's a couple new entrants in this business, and I think that's what you're talking about, what's new. We found that there's new ways to add values to clients with a better technological platform. You know, commissions and spreads of buying individual stocks have declined, so the benefits for direct indexing have kind of been broadened out. Ari, why don't you take it from here?
So thanks, Ben. Thanks, everyone, for coming. I think that direct indexing, by the way, is a concept that goes back several decades. The original players were really existing in an analog world, mainly paper and email-based. And the space has really evolved to be able to deliver customization at scale. Technology really is the key entrant into the evolution of the space. The ability to have the complete workflow from creating investment models, linking new accounts to those models, being able to set tax budgets and do tax transitions, all online via portals that are connected to the custodians, process transactions, customize accounts, so that now things are really more efficient for advisors. As an example, you know, it's not uncommon for some legacy players for tax transition can take several days. With new players, it can take seconds. I think the other evolution is it's gone beyond now direct indexing, which is predominantly market cap, you know, indices, into more examples of customization. The concept of custom indexing, where an advisor can build their models across the cap and geographic spectrum, reflective not just of passive. Certainly there's the ability to set allocations to passive, but there's an ability also to do more than that, to have exposures for fundamental principles like value or dividend growth or dividend yield or quality or low vol expressed in the portfolio as well. That gets back to the concept of scale, because as the product offering grows and evolves, it's allowing the advisors to do more within the context of a custom indexing platform.
So what kind of clients make sense to utilize direct indexing? So I guess, what's the kind of general use case, and what's the kind of profile of the typical investor for which this might actually be a fit for them relative to the traditional SMA wrapper or even ETFs or 40 Act funds?
All right, I'll chime in as the index provider. I'll speak from probably a little bit of a different perspective as an index provider. But you know, in our experience, we consider ourselves one of the leading providers of index and benchmark-based solutions for various types of capital market structure, and direct indexing is not, you know, new to that ecosystem for us. In most of my conversations and working with great clients like OSAM and Vanguard, we often find that there's similarities between clients. These would be clients that are looking for some sort of customization or specialization. Maybe they have unique tax needs or planning needs that are specific to their spending targets or charitable contributions. there's typically a profile that's very similar, at least within the retail spectrum. And there are certain profiles in the institutional spectrum where direct indexing or custom indexing would be appropriate for that type of a client as well. What I will say is that there's a lot of debate on who it's not right for, right? When you start thinking about things of pricing of particular investment vehicles, fee compression, I think there's probably a lot of head nodding once I say fee compression around the room. There's nowhere to hide from that type of stuff. Because direct indexing does provide additional utility and functionality above and beyond kind of legacy wrappers with maybe in the ETP space, they tend to not be as cost efficient. And so there's often these trade-offs that you as advisors or asset managers in the room would need to determine, hey, what is the utility and what's the priority function that these particular clients would benefit from? If it's tax optimization and customization, direct indexing is probably a good solution. If it's cost efficiency, an ETP might be a better solution. But as the landscape continues to evolve and the complexity and the ability to improve the trading ecosystem evolves as well, we're also seeing entry points that didn't exist before. I know when I started, and I worked in the buy side for many years, we were looking at maybe multi-million-dollar entry points down to the hundreds of thousands. And now there are institutions out there that are providing custom opportunity based on these trading optimization platforms that allow for entry in the thousands of dollars. So, if we had this conversation 2 years ago, I'd probably say it's specific to ultra high net worth clients with unique tax needs. Today, based on the entry points and costs coming down, I think it's actually more ubiquitous for many clients that don't have as sophisticated of needs.
Well, I'd say some specific scenarios that Vanguard personalized indexing has encountered. Certainly taxes are the main driver at this point. Within our client base, 80% of those accounts are probably there because you want better after-tax returns. They like indexing and everything it brings, but they want a little bit more for that particular client who might have a lot of capital gains in their life, or one single investment that they're going to be selling with a realized gain pretty soon. Or maybe the advisor is intentionally putting them in things that have a lot of capital gains generated every single year, like active mutual funds or private equity or hedge funds. So in that case, the direct indexing account then lives right alongside that other model and acts as an absorbent sponge, if you will, and kind of soaks up those gains with giving some losses. So even though there's a ton of customization, Vanguard's platform has a lot of things you can do, ESG factors, be very granular. Most of this right now, and for our opinion, is maximizing indexing through after-tax returns.
I would say that from the standpoint of the advisor, what kind of advisor do we see that tends to be drawn to the offering? First, because back to that, the concept of now, web enablement and technology, clearly there is a group of advisors that's growing by the day that understands the relationship between technology and scale. And they're looking for ways to effectively and efficiently scale their business. And that's a very strong cohort that we see running through our business of advisors. And then I think they're looking now to take that to the next level to say, perhaps the application of looking across the style box world for different players, is something they're looking to do more efficiently. And to be able to provide exposure to different sources of beta and potentially active sources of return in a vehicle where it's one account and they have the levers that are available to them to manage the tax exposure of their clients, the customizability, all via one platform. That they're saying, perhaps mutual funds and ETFs deliver that less than they did, relative to other opportunities that are out there, and that they could build their businesses efficiently.
So if you read CityYRA, and I see a few readers out there in the crowd, then you know that one thing that we love and that I love writing about is deal making. And I'm fortunate that two of the men on the stage with me have been part of two of the biggest deals in the asset management industry in the last couple of years. And I'm referring specifically to Vanguard's acquisition of Just Invest, which was the company's first ever acquisition, and then Ari part of Franklin Templeton's purchase of O'Shaughnessy Asset Management, also in 2021. from both your perspective on both sides of the deal table, why has direct indexing been such an area of interest for the largest institutional asset managers in the space, which historically, some could say they've been slower to adapt to certain investing trends relative to others?
Thanks, Ian. If I would have been one of your sources, I would have given you a heads up on that, so you could have broken that news. So at Vanguard, it was our first acquisition, and we had been watching direct indexing for a long time. And I mentioned a couple trends that had to occur before we felt like, all right, now is the time. And one of those is, commissions have fallen across RIA custodial platforms to nearly zero. Spread costs have come down. So the benefits of tax loss harvesting with this type of strategy is available to more investors. We also see that there's more software, more modern technology available, so the experience of a direct indexing provider can give an advisor a more modern feel and save you a lot of time. But for Vanguard, it boils down to our core purpose, which is we exist to help investors succeed. And we felt like for some investors, and candidly a lot of investors that advisors mostly work with, direct indexing oftentimes can do better than an ETF and mutual funds if they have a lot of taxable gains. And so that ability and that thinking, we care deeply about helping advisors improve their clients. Vanguard's business might surprise some to realize that our single biggest client group is financial advisors. 45% of our total AUM is held with advisors in their accounts on behalf of clients. So helping advisors, give them a new tool to improve the outcomes of their underlying investor has been super exciting and something that we're going to be doing for a long time.
So for our firm, we had roots in legacy portfolio management and had been managing assets for decades and had built a suite of proprietary tools that our portfolio managers were using via software, all via software to help our business scale more efficiently. And we had always been implementing through SMA as our primary vehicle. So the firm had a legacy of tax and values preferenced investing over time. And we realized collectively as we grew over time, we had pointed this technology that we had built really internally for our portfolio managers to run our process. And the thought dawned on us, it was really an experiment. What would happen if we took the tools we'd built for portfolio construction and slid them across the table to the advisor and let them then use those tools to build their models in the way that they wanted to and outsource the application of that and the expertise of that to us for trading on an ongoing basis for the tax management. And so it started as a conversation with a handful of advisors where we showed them the platform and the tools that had been built, and they found it very compelling as a way to make their business, run more efficiently. And so it was the application of trying to help advisors deliver better value to their clients that provided the opportunity. Franklin Templeton, is one of the world's foremost SMA managers. There were a lot of synergies. They were looking to enter the space, had considered the possibility of building it themselves. And then when they saw, as a company really of some world-class portfolio managers, when they saw the capabilities that we had built for portfolio management, there were synergies that they felt they could take advantage of through acquisition. And that would help our business grow over time to be able to work with more advisors to help their clients. And I think those that are entering the space are probably, having a similar thought pattern.
Yeah, I was just going to add, one of the words that you used a few times is synergies. And we think about that a lot as well. And how can we enhance synergies with the convergence of multiple factors that are on the table today that maybe didn't exist to the same extent just a handful of years ago? So in addition to client and advisor synergies, you look at things like fractional share trading, $0 trading costs, centralized trading desks, very more efficient tech stacks that can be integrated into the RIA space, the independent space, and the wirehouses. A lot of these things converge together to provide a great ecosystem for direct indexing, and it makes it, I'll say, less complex to now deliver to clients at a more mass level. And so that doesn't get lost on the large decision makers at some of the bigger firms to make sure that they're investing in this space where there is opportunities for these enhancements to synergies.
I would kind of like to zoom out for a moment because in some of your answers, you kind of talked about how one of the factors here was the drop in trading commissions to zero on a lot of the large brokerage platforms. And I think that that kind of fits in with, I think, two of the broader forces that we've seen kind of work their way on investing the last couple of decades, which is this general trend towards cheaper and towards passivity. And so I guess where does direct indexing kind of fit in on that spectrum from kind of a cost basis?
Well, being low cost and passive is something that we think has done a great deal of good for a lot of investors. And yeah, those trends are certainly at play with direct indexing for sure. I think it's also taking it further on a few other big macro trends in the advisor space, which is thinking and acting like a fiduciary, which has happened more and more the last 10, 15 years, incorporating financial planning and deep financial planning into the client conversation, and then thinking about taxes, either before you build the portfolio or after. So direct indexing hits all of those notes for advisors. Some of the first advisors we start working with oftentimes are people who hold themselves out as excellent financial planners, or maybe they're inside an accounting firm because they're already thinking about taxes. So those trends are definitely at play. I mean, we think about all of the things that advisors do to help clients, and we've called this Advisors Alpha. This is another leg of Advisors Alpha. We have a client on the East Coast that's using Vanguard personalized indexing who I'm straight up stealing their term, but they said, we can get the same investment exposure with our model through ETFs or mutual funds or direct indexing. And so for every client, we decide which structure is going to meet their needs best. And so for that context, it's structural alpha for them. They're putting them in a direct indexing account and absorbing extra tax losses that are going to offset gains. So those are some of the trends that I see a lot. Ari, what do you think?
Yeah, I would echo things that Ben have said. Certainly the move to passive is pronounced. Direct and custom indexing is only furthering that. Technologies and economies of scale are bringing down costs in the space. It's common for us to see portfolios of ETFs and mutual funds where a direct or a custom index is coming in at a lower cost and providing the opportunity for tax management and tax alpha. And even in the cases where perhaps the ETF portfolio is still lower cost, for a taxable investor, net of tax impact, an ETF is a vehicle that sets a price on an ongoing basis, and a mutual fund at the end of the day. Obviously, markets are up more often than they're down. Generally, 75% of the time, markets go up. When those securities are packaged in a wrapper that's in the form of an ETF or a mutual fund, traditionally it's hard to generate losses on that because the price of that vehicle is going up more often than it's going down. If you look at a predominant index like the Russell 1000 over time, and you look at the underlying constituents of those holdings, on average, inclusive of years where markets are strongly up, more than 30% of stocks in the index are down. And so when those become unbundled in the form of an SMA, they can provide an additional source of benefit to the client in the form of tax alpha. And so, this is only furthering indexes efficiencies. People went to indices, I think, in the beginning because they're hard to beat, and they're really hard to beat net of taxes. They're very efficient. This is making the vehicle, the concept, that much more tax efficient because it's bringing a benefit that you wouldn't get in that packaged wrapper.
Yeah, I mean, obviously we love passive as the only, we don't offer other options essentially, right? As an index provider. And Ari had really good points on, if you look at a wrapper that tracks an index, you have one opportunity based on that price point. But if you look at an index with constituents that move at varying degrees based on that particular time interval, there's additional opportunity for you to bring value to a client experience depending on the value that that client might be looking for. So, we provide research in this space in the sense that we look at our indices and we publish what are called dispersion and volatility dashboards, where you can actually see what's happening inside of the index at the constituent level that could present potential optimization opportunities where you can then track the index, but then capture losses, weight certain factors in a way that would benefit the client, whether it's a dividend value or low vol. So, I won't touch on the cost structure itself, but it is fairly evident that there is a lot of value in passive by itself, if anyone's ever read our SPIVA report. And it's also evident that there's opportunity inside of that passive methodology to bring value to your client's experience.
So kind of staying zoomed out of this sort of 30,000-foot view. So I guess generally, what do you see as kind of the risks associated with the wrapper? And then, I'll ask the question that I would ask to any mutual fund or ETF manager, which is, how do you guys manage for tracking error?
Well, I'll take tracking error, and then we can kind of zoom back out to risks. But every single day, Vanguard's systems looking at every single portfolio on our platform. And that was a bit of a technological leap. We've pushed the industry forward in that regard. That was kudos to the Just Invest team, who's realized that the industry needed that and then had some deep expertise in MSCI Barra and can extract more horsepower from that optimizer than anyone else. But every single day, our portal's looking at every single account and trying to determine, all right, is there an opportunity here to tax loss harvest that's going to be meaningful to that client based on their specific tax rates that you give us? So it's all personalized to that individual. And if, for instance, there is, then we're going to say, all right, great, well, what are we going to sell? And the optimizer is going to do some algebra. What's leaving the portfolio? What's available to purchase? And then from a factor basis, what do we need to buy to potentially replace it? Because we're still shooting for the index, to be sure. Vanguard cares deeply about index tracking. So we want to make sure that your pre-tax return is awfully darn close so that your post-tax return can go above and beyond that. I jumped on that question. Why don't you do risks, or I can chime in there?
Yeah, I think the key risk is the concept of tracking error, because no trade is free. As everyone in the room knows, you don't get something for nothing. So on platforms like this, the advisor is having conversation with their clients about their tolerance for deviation relative to the underlying investment, relative to the opportunity for tax loss harvesting. That's the trade, right? Because the client's setting a budget, and it's based on their sensitivity in conversation with their advisor. How concerned are they about the ability to perhaps, how interested are they in the ability to generate tax offsets on gains versus how concerned are they with their deviation of their account relative to the underlying model or index in which it's invested? That deviation is tracking error. It's just drift, right? Statistically, how different are you going to be relative to the investment? The more the client wants to potentially save on taxes, and that goal may vary year to year. In the year where perhaps the client sold the business, or in anticipation of selling a business, perhaps they want to dial up more opportunity for tax loss, chance. And that would then widen the deviation of the portfolio relative to the index or the model in which it's invested. That's tracking error. By the way, tracking error in and of itself is not necessarily bad. It just is. The deviation can happen on the upside, but certainly the advisor wants to have the conversation with the client about, hey, in anticipation of the ability to offset losses, you need to know that the portfolio manager will be managing the portfolio perhaps slightly differently from the index. And that could result in underperformance relative to the index. To the concept of how it's optimized for, it's a similar process to what Ben had described. I use the analogy of a puzzle piece. There are stocks in the portfolio that are at a loss, and they form the shape of a puzzle. It's an exposure. They have a certain market cap and a certain sector and a certain country and a certain fundamental exposure. And what we're seeking to do to take the loss and minimize tracking error is sell out of the stocks that form that puzzle piece and then fill the puzzle piece back in at the same time with the stocks that form the same shape, that they look highly similar from those same principles of market cap and geography. And so we're doing everything we can to stay in balance and to keep that tracking error as low as possible over time.
So we've talked a lot about decisions made at the fundamental manager level. Where does the index provider itself kind of fit into this whole dynamic?
Yeah, it's an interesting question, and I think probably one that a lot of folks don't think about. Direct indexing, as we've already highlighted, it's been around for a while. It's been around over 30 years. There's a couple major players that have been doing this for a really long time. And so it's by no means a new concept, but depending on the arena that you're having the conversation in, direct indexing kind of takes its own form in different conversations. There are providers out there that would do a multi-asset, tax-optimized approach with commingled vehicles, and they say we're a direct index platform. And maybe they are. And there's other areas where it's a fixed income custom ladder. They would call themselves a direct index platform, and maybe they are. From the index provider, I think we look at it a little bit differently. So what is an index in its most conventional sense? An index is a list of items that's rules-based that tends to capture very similar objectives amongst that group of things, right? So the S&P 500, large cap U.S. equities, there's a handful of other considering factors, but all the 503 constituents within that index have very, very similar profile, right? And so what we do is we try to provide, again, these enhanced synergies that I mentioned before. Right now we calculate around 1 million indices, and the indices are designed to be fully transparent and publicly published. And that's really, really important because transparency, I think, is becoming more crucial to clients every single day based on the fact that there's just a lot more of information out there that's accessible, not just to you and I, but to also our clients. And so by providing rules-based, transparent, publicly published indices, we can then essentially license those indices through intellectual property and data rights agreements to companies like Vanguard and OSAM and many others. And ultimately, depending on what type of exposure they feel is suitable for their clients, what type of indices do they want on their platform to complement or compete versus other index solutions, we want to be sure that we're providing that pricing structure. We're consistently publishing all of the corporate actions. We're having consistent communication and dialogue with all of the exchanges. And we're providing that intellectual property through seamless feeds that allows asset managers or wealth managers or even financial technology companies to have a tradable basket of securities that ultimately aligns with that publicly published methodology. And as this landscape continues to change, it's also evident that certain asset managers are interested in creating uniqueness amongst their offerings. So, we've taken a little bit more of a front seat in the approach as opposed to maybe what we do through some other licensing conversations. And the reason that we do that is because I'm often on a call with, it could be a brand new company that's still in the VC stage. It could be a very well-established company like these gentlemen work for, but they may be looking to create new methodology. So they might come to us and say, hey, we're interested in having this type of exposure, but we want to change 1, 2, 3, X, Y, Z, and whatever, ABC. And we say, okay, and we will take it back to our research and design team. We'll make sure that there's enough trading history, enough pricing history, and that we can ultimately calculate these indices on a go-forward basis and distribute that data to the asset management teams to allow them to trade that basket of securities based on the individual client's needs. So it actually gets a little complex behind the scenes, but we'd like to think that we're pretty integral into that conversation. And right now we're the world's largest provider of benchmark solutions within the direct indexing space.
So I think that we've established that direct indexing in and of itself isn't new, but the level of institutional interest and institutional investment is. So kind of given that, 10 years from now, what do you think are kind of realistic expectations for the level of market share of total investor assets that direct index SMAs could have? And I mean, is this going to be something that could gain market share at the expense of ETFs, mutual funds? I mean, where is the opportunity for it to capture market share, and what could it realistically look like in the medium term?
So if you think about the predominant vehicles that are out there for choice, you've got traditional SMAs, you've got mutual funds, you've got ETFs, and Cerulli, which is a consulting firm based in Boston that does a lot of data on the RIA and asset management space. They're kind of the McKinsey of our industry. They've done a lot of research on this that suggests over the next several years that custom and direct indexing will outpace all of those vehicles. That at about a 12.5% annualized growth rate. The next closest would be ETFs at 9% per year. So this is projected as what will be the vehicle of choice within the wealth management industry over the next several years. I'm not sure about 10 years, Ian, but I know that over the next 5, they're projecting that assets will about double in the space to getting close to $1 trillion in assets.
I think size-wise, direct indexing is going to be smaller for a long time. The ETFs and mutual funds have just gotten a huge head start, and they're going to continue to be very useful for a lot of clients. But when I think about that question, sometimes what's underneath it is the worry, hey, is this a fad? You know, fads exist in our industry, and is this one of them? Should I avoid it? And I kind of smile when I think back to some of the clients I've worked with. I'm from Portland, Oregon, up in the Pacific Northwest, who have been doing these types of strategies for decades. And these advisors are not fools. You know, they've done the tax math on behalf of their clients, and they've recognized that, yeah, this strategy actually does pencil out. So now, of course, we're new entrants into the space. We're trying to improve that tax math. We're trying to improve that outcome. So I certainly don't think it's a fad. You know, how much it's going to grow is tough to predict. My own personal metric for this is just thinking back over the past 3, 4, 5 years that I've been doing a lot of these conversations with advisors, and every single year this continues to be true. More advisors are more open to direct indexing. And as long as that holds, it holds in 2023, we'll continue to grow.
Yeah, I mean, all really good points. There's a lot of education that I think is required to be sure that as an advisor, you're comfortable implementing these solutions. And then I also think from a solution perspective, there's been a lot of evolution recently too. There was an article maybe a year or so ago, and it's quoted a gentleman as saying, a direct index provider is like a chain restaurant. Right? It might be a good experience, but there's a lot of similarities. You can go from one to the next and have a very similar experience. And it's like, yeah, like that's the idea, right? Indexing is not inherently sexy or unique. It's a rules-based function, and it ultimately gives individuals the opportunity to get market-like returns. But if you look at some of the data more recently, you know, a lot of this started in the U.S. large cap space. So there's a few indices, you know, one is a shameless plug, but there's a lot of other really good ones out there too that occupy a similar space in U.S. large cap. If you look at the last maybe 12, 18 months of flows within the SMA space and direct indexing, it's evident that advisors are implementing this in spaces that are of complementary sizes and styles. And it's also evident that based on some recent work that we're looking to provide liquidity sourcing in global markets and international markets. You know, how can we make sure that we're creating indices that maybe conventionally traded on a foreign ordinary basis are now being replicated via ADR or OTC instruments and allowing clients to access these vehicles in a way that they really couldn't before. And then I think we'll probably see some evolution maybe within the derivative space and providing experience on, you know, call options in individual positions or the indices themselves, collars for dampening of volatility. So essentially giving a client index-like return exposure with derivative instruments inside. There's a lot of different ways that I think that this can start now going, but ultimately it will be complementary to like what's been built already in the large cap core universe.
So we've got just a couple minutes before we open the floor to questions. So before I open the floor, one question I've got for you guys is, I'm a big fan of Eric Balchunas from Bloomberg, who follows ETFs, and Eric loves talking about this idea that for ETFs, there's this terror dome, where ETFs that track new concepts or have new fee structures or work with crazy indices, that they'll either attract a critical mass of assets and they'll thrive and they'll set a new standard, or they'll die on the vine. And so for you guys, is there such a thing as a sort of terror dome for direct indexing? And I guess what do you see as the opportunities out there for innovation or disruption in the space?
I'll start with where Ben began. At the end of the day, the structure is in SMA. So where are there opportunities to help the advisor expand their efficiency? It's, you know, as Brandon has said, predominantly started as U.S. large cap, but it's expanded, and I think it will continue to expand. The choice will continue to expand for advisors. Fixed income through individual bonds, as an example. You had mentioned the opportunity for options. I think that there will be more choice with regard to fundamental exposures across caps and geographies, that the vehicle will continue to become more efficient as players in the space innovate, and that will result in more choice for the advisors over time.
I get where Eric's coming from, though. I mean, this does kind of remind me a little bit of the onset of ETFs, where new entrants into the market were coming out of the woodwork. And I think the lesson from that was not all of those players are here at the end of the race. On our side, we're going to keep innovating in terms of the client and advisor experience, making sure our portal, you can do transition analysis like that. You can communicate to our team really easily. It's not a big disruption in your practice from an operational standpoint. So there's more work ahead for sure for all of us, but it's going to be fun.
Yeah, I think you said Terror Dome. I keep thinking Thunderdome. 2 men enter, 1 leaves. But no, again, echo all the same points, right? I think we've seen a similar song or dance. History rhymes, but innovation doesn't stop. And so we're at this opportunity where direct indexing is just the innovative opportunity set to access these capital markets. Very similar with ETFs years ago. As long as there's interest to access these types of markets, new technology, trading costs, things are going to enable asset managers and wealth managers to do this a little more efficiently as we move forward.
So we've got just under 4 minutes for questions. So if you guys have submitted anything through Slido, I should be able to see those any second. If we could pull any up. No questions yet. That's fine. I still have a couple more. And I guess for you guys, what do people get wrong about the concept of direct indexing?
I think the industry has gone a little bit overboard in terms of personalization. I mean, I shouldn't say that. Our service is called personalized indexing, but the fact that you need every single person in your book to have their own specific account or their own specific index is probably a bit much. We see a lot of advisors pick certain themes that they want to emphasize, and then they replicate that across their book. Or we see one-offs where, hey, I work for an airline company, so let's back down on that exposure. This idea that everyone's got specific ESG concerns or specific customizations that they need might be a bit overdone. You can come to our booth. We'll have a cocktail hour right after this where you can see the actual portal. You can see how quickly and easily it is to set those customizations. Again, 80% of our clients, though, can see those, and nice to have them and use them on occasion, but they're here because they want better after-tax returns from classic indexing solutions.
I would say some of the devil's in the details with your relationship with your custodian. Generally speaking, commissions are free, but as an example, if the client chooses to get statements via paper, right, that there can be a charge. So knowing your setup with your custodian, we coach our advisors, through this as we're going through training. There are absolutely ways to make the experience more efficient. But, at the end of the day, when you're doing this via portal, it's a high-performance order entry, system. And so knowing how it works and how you're directing the trades, how the custodian is going to respond, making sure that things like their tax relief methodology is aligned with the asset managers at the account level. There are just fine tunes that can happen at the operational level that help this run more smoothly.
Yeah, I'll concur. The concept of scale does not die with direct indexing. I think probably the most valuable thing to everyone in the audience is time. And so how do you integrate direct indexing into your practice? You do it with scale, right? So to Ben's point, every client's not going to look totally different because that's going to take a lot of time to justify, design, develop, deploy, defend, right? So making sure you're doing this with scale, working with an expert like the 2 gentlemen up here, I think will allow you to bring that value to your clients, but do it in a way that protects your business too.
So super quickly, because we've got just about a minute left, does it make any sense for a client with appreciated ETFs to transition to a direct indexing approach?
So I'll go quickly. The majority of the accounts that we see opening are not funded with cash. They're funded with securities that have a lower basis, oftentimes ETFs and mutual funds. And the advisor's looking for a way to take a little bit of the gain off the table, fund a passive allocation alongside, to be able to work in tandem with that ETF and that mutual fund to provide an opportunity for ongoing loss harvesting so that the gain is going to continue to compound in that wrapper. With the direct index, The client is in an opportunity where we can pair losses against gains over time once that transition begins.
So my favorite thing about journalism is that I get to go out, I get to ask a bunch of people who know a lot more about a topic than me and ask them to teach me something. So I know that I've learned a lot, and I hope that everybody out here has too. I just wanted to thank you guys for your time, and thank you all for listening.